So hopefully by this point, with the market structure, supply and demand, and imbalances, you're getting a general idea of the trading system that we're going to use. Now in this video, we're going to talk about liquidity. Liquidity we've spoken about in two previous videos already, but this time we're going to bring it into this trading system, and I'm going to show you where it actually plays its part and the role it has within our system. So as you'll know by now, liquidity forms at equal highs and equal lows in the market. So I've actually marked out liquidity with these little money signs, okay? Because we know that liquidity refers to orders, stop loss orders, buy orders, sell orders, and so on in a market. And just as a quick recap, the reason that liquidity gets taken out is because we have institutional market participants who want to sell or buy from supply and demand zones, okay? So what actually happens is the liquidity forms at equal lows or equal highs, and the equal highs or equal lows form from retail buyers or retail sellers. So they're usually buying with stop losses either beneath, or they're selling with stop losses above those equal highs, looking at double bottoms, triple bottoms, double tops, and so on. These kind of retail patterns that everyone is using. So when we actually get these retail patterns, we then normally get a drive through the liquidity, which triggers the stop losses of these retail traders, which frees up orders into the market for the institutional participants to then put their sell orders or their buy orders on. So what we actually like to see when it comes to our system and liquidity is a trading range like this, where we have equal highs and equal lows, and we can see a trapped range with liquidity either above or below or both sides. When we get something like this, we can expect that the liquidity is going to be taken out, and we can use this in line with our imbalances, supply and demand, and structure to actually find opportunities in line with the trend. So in this example, before we head over to the charts, we can see that this is generally an uptrending market, okay? We have a large impulsive move, that we then have a corrective down move, and then the market begins to range. So at this point, we have buyers buying in who are looking to take the market higher. And we will also have a few sellers who are seeing this resistance point and are looking to sell down from obviously the double top that we've seen in the market. So at this point, the market makes a push up. This is obviously going to attract more buyers. And what this is also going to do is trigger in breakout traders who are actually sitting with orders just above this level because they're waiting for a breakout to then buy into the trend, thinking that that's a solid confirmation. What instead happens is the breakout traders are triggered in. Any sellers here are taken out. The market reacts from a supply zone. And the reason that this happens is because we have liquidity down here, we have an imbalance down here, and a demand zone down here. So at this point, we are essentially just clearing out the liquidity before we form the real move in the market. So in a range like this, we could see this from this point as, okay, we are likely to push back up to take out this liquidity. And if we do so, we are then likely to push down before the trend continues because we have liquidity down here as well. We have inefficiency, imbalance, and a demand zone that needs to be retested. So rather than being one of these traders, the retail traders, either looking to sell from the resistance, buy from the support, or buy from the breakout, we want to be actually trading with the liquidity and with the order flow. So whereas all three of these traders would have just taken a loss on this big push down that we get, we want to be actually following the order flow, and we can easily find opportunities selling from here and then buying from here, okay? So we have a very clear understanding of how the market moves, and this is what we actually do in our system. This is where a lot of trades are formulated. So you can see everything coming together now. Obviously, this trade includes everything we've spoken about so far. The overall structure being bullish, the supply and demand, obviously for supply for sell entries, demand for buy entries, the imbalance inefficiency that we just spoke about in the previous video in terms of seeing imbalance either side of this, and now bringing the liquidity into it to actually see where the retail traders are, see where they are buying and selling, and using that to our advantage to identify areas where the market is likely to actually sweep before giving us our trading opportunities. So what we're going to do now is head over to the live charts, and I'm going to show you an example of liquidity in the markets using the live charts and using everything we've spoken about so far. Right, so over here on the charts, I'm going to show you an example on Euro USD. So as we can see, Euro USD 15-minute time frame, we are in an uptrend. We shifted the trend at this point. We formed higher high, higher low, higher high, higher low. Now we're kind of trading within this range, but we can indicate that the market is likely to go up because we are still forming higher highs and higher lows on the overall trend. So if we look at the current market conditions, first of all, we can plot out the liquidity because as we can see here, we have a range of liquidity, okay? Equal highs and equal lows surrounding price. So at this point, we've got the equal lows in the market here, and we even have this little collection of equal highs as well. So if we look either side of this, we're going to see clear indication of what we just spoke about in that example. First of all, above the equal highs here, we have an imbalance in price, leading us into a supply zone. Okay, so if we just mark that on, we then have beneath the larger liquidity, another imbalance to the downside here, inefficient pricing. This one is in line with the overall trend, the overall bullish trend. So marking on the demand in this region here, we can now see that we have a clear demand zone that we would like to buy from in line with the overall trend, and a potential selling zone if the upside liquidity is taken out. Okay, so we have the essentially smaller time frame liquidity imbalance and supply zone, and a larger time frame liquidity imbalance and demand zone in line with the overall trend. So what we can actually look at here is potential for trades both ways. If we push down from where we are, we can buy from there. If, however, we do first of all come up, which we are likely to do because we're likely to clear out the liquidity both sides, we can then look to potentially sell from this level, bring the market down into the buying zone, and then take it up from there. Okay, so if we just clear these off for a moment, and if we actually, using this information, plot some order ideas on the chart, we could first of all look at a short position from this level, stops over the highs, targets into the demand zone. We can also then look to put on a buy position, let's say from the midpoint of the larger demand zone, stops under the next low point, and then if we target this into, for this example sake, we'll go for the supply zone here. So we have a potential 10R short down from supply, a potential 9R long up from demand, and if we allow the market to play out, we will indeed see both of these positions are triggered. This one very close to the stop loss, but didn't quite tap it because we used some logical positioning. The 10R position comes in filled very nicely, and the other position now, the higher time frame position, if we just shift it up to a higher time frame slightly, should work out quite nicely. So there we go. That is the idea of bringing liquidity into your trading. Now, as you can see, obviously we've got retail sellers at this high. We have retail breakout traders above the high. We have retail buyers in these lows. So using everything I just told you, it's very likely that the liquidity is going to be swept out both ways. Now you can see the imbalances, the liquidity, everything has been swept out. Okay. So if we just quickly recap this whole scenario in the market, we first of all have a bullish uptrend, leaving open an imbalance here. We then form a tight trading range, and imbalance is formed just above as well. And then within the tight trading range, we have another imbalance. We have liquidity here, we have liquidity here. So we can indicate that when we're in this range, we are likely to sweep the liquidity above and below. And as you can even see from this example, we've then gone up after sweeping the liquidity out both these levels, filled this imbalance, and then began moving to the downside. So as you can see, the imbalances, the liquidity, the supply zones and demand zones are always filled within price. And even if the market reverses from here and we don't continue with that uptrend that was the initial idea for the trade, we've got some massive profits. This is a combined total of 9.2R plus 10.2R, so around 19.4R potential. At 1% risk, that is a 19.4% gain in a couple of trades in one single trading session. So this has been the liquidity video. The key pointers are: liquidity is used for, first of all, avoiding bad buys or sells. Second of all, finding good selling or buying positions by pairing it with the structure, supply and demand, and imbalances. And third and final, using it for targets as well. If we have imbalances, if we have liquidity leading into a region, we can likely use that as a target. For example, this one here, we entered based off liquidity, and then we actually targeted this level because this liquidity told us that this floor in price was very, very likely to go through. So I hope you found this video valuable. I hope you've enjoyed it. Hope everything is coming together now. You can see that this is a step-by-step system. First of all, identifying structure, then identifying supply and demand, then moving on to find imbalances, inefficiency, and liquidity. And now we're actually going to move on to some of the overall processes of it. So entry types and a little discussion of the market, show you some examples as well. So thanks for watching, and I will see you in the next video.